Welcome to our guide on stopping the retirement tax trap. Today we will demystify mysterious refunds and 401k rollovers so you keep more of your money and avoid penalties. We will transition from defining the types of money to choosing the best rollover path, and then finish with an action plan you can follow immediately. Here is today's agenda. First, why tax traps happen. Next, we identify your money type. Then we address the after-tax refund dilemma. After that, we choose the best rollover routes. We will cover the 60-day rule and trustee transfers. Finally, we will close with an action plan, plus a documentation checklist. Now, let's set the stage with a quick overview of the trap itself. Changing jobs often triggers distributions or refunds from old retirement plans. If you move funds incorrectly, you could face taxes, early withdrawal penalties, and withheld amounts you did not intend to pay. In this video, we will guide you along a structured path to keep your funds tax advantaged. With that foundation, let's clarify the exact type of money you are dealing with. Before we dive in, please note that this content is educational. It is not tax, legal, or investment advice. Rules can vary by employer plan document, state, and your personal tax situation. Always confirm with your plan administrator and a qualified fiduciary advisor before moving money. With that in mind, let's identify your money type. The crucial first step is to classify the money type. Pre-tax 401k funds are contributions you deducted and the earnings, both tax-deferred. Roth 401k funds are contributions made after tax, with qualified earnings growing tax-free. After-tax non-Roth contributions are different from Roth. The principal has already been taxed, but the earnings are still tax-deferred until converted correctly. Pension or defined benefit refunds often return employee after-tax contributions along with taxable credited interest. Non-qualified plans follow employer-specific rules and can be taxable when distributed. Understanding this taxonomy determines your rollover route. Next, we will address the after-tax refund dilemma. The controversy arises when after-tax, non-Roth contributions are refunded or distributed. Your principal was already taxed and should not be taxed again. However, any earnings remain taxable if you cash out and may incur a 10% early withdrawal penalty if you are under age 59.5. The correct routing separates principal and earnings so you preserve tax advantages. Commonly, you direct the after-tax principal to a Roth IRA. You then direct the related earnings to a traditional IRA to keep them tax-deferred, or to a Roth IRA if you are comfortable paying tax on that conversion today. Verify treatment using the 1099-R and 5498 forms. Now that the stakes are clear, let's visualize the decision path. This flowchart shows the routing choices. If the funds are pre-tax 401k, use a direct rollover to a traditional IRA or to your new employer's 401k. If the funds are Roth 401k, move them by direct rollover to a Roth IRA or Roth 401k. If they are after-tax non-Roth, split the money. Send the principal by direct rollover to a Roth IRA and route the earnings either to a traditional IRA to avoid current tax or to a Roth IRA if you are intentionally converting and ready to pay the tax. For non-qualified plans or defined benefit refunds, confirm the plan's rules and separate principal and interest accordingly. Throughout, insist on trustee-to-trustee transfers and avoid indirect 60-day rollovers. With the map in mind, let's turn it into a step-by-step action plan. Here are the steps. First, call your old plan and ask for the exact money type. Second, request a direct trustee-to-trustee transfer, ensuring no checks are made payable to you. Third, separate after-tax principal from earnings explicitly on the transfer forms. Fourth, route pre-tax balances to a traditional IRA or your new 401k. Fifth, route the after-tax principal to a Roth IRA, and route the earnings to a traditional IRA or to a Roth IRA only if you are willing to pay the tax today. Next, obtain a letter of acceptance from the receiving custodians. Then confirm that your 1099-R and 5498 reporting match your intent. Finally, document every interaction, instruction, and confirmation. Now let's ground this with numbers. This table illustrates a sample breakdown. $60,000 of pre-tax 401k funds move to a traditional IRA or new 401k with no immediate tax and tax-deferred growth. $15,000 of after-tax principal goes to a Roth IRA with no immediate tax and the potential for tax-free qualified growth. $2,000 of earnings on the after-tax contributions go to a traditional IRA to keep them tax-deferred, or to a Roth IRA if you choose to pay tax now and aim for future tax-free growth. Similarly, $1,200 of defined benefit refund interest should generally be treated like pre-tax earnings and sent to a traditional IRA unless you intentionally convert. With numbers in mind, let's compare destination accounts. On the left, the Roth IRA involves paying tax now for tax-free qualified withdrawals later. It is a logical destination for after-tax principal. The Roth IRA typically has no required minimum distributions, making it attractive for long-term tax planning. On the right, the traditional IRA or 401k avoids tax now but is taxed when you withdraw. It is ideal for pre-tax balances and for the earnings portion of after-tax funds if you prefer deferral. It is subject to required minimum distributions. Understanding this trade-off helps you decide how to split funds. Next, be cautious about the 60-day rule. An indirect rollover occurs when funds are distributed to you. This often triggers mandatory 20% withholding and starts a 60-day clock. If you miss the deadline, the distribution becomes taxable and may incur a 10% penalty if you are under age 59.5. The safer path is to avoid this entirely by using a direct trustee-to-trustee transfer, which has no 60-day clock. Having covered timing risk, let's show the workflow behind a trustee transfer. This sequence diagram will illustrate each actor in a direct trustee-to-trustee transfer. You initiate the request with the old plan. The plan verifies money types and splits after-tax principal from earnings. The plan then sends pre-tax balances to your new 401k or to a traditional IRA. Simultaneously, it sends the after-tax principal directly to your Roth IRA and the earnings portion to a traditional IRA unless you elect a taxable Roth conversion. Custodians issue confirmations, and the IRS receives a 1099-R from the distributing plan and 5,498 forms from receiving IRAs. At no point are funds paid to you. With the process visualized, let's test your understanding. Question: you receive a refund that includes $10,000 of after-tax non-Roth contributions and $800 of earnings. What routing best preserves tax advantages and avoids current tax? Options are A. Send all $10,800 to your new traditional 401k. B. Send $10,000 to a Roth IRA and $800 to a traditional IRA via direct transfer. C. Cash it out and redeposit within 60 days. D. Send all $10,800 to a Roth IRA via direct transfer. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Sending $10,000 of after-tax principal to a Roth IRA preserves its already tax status and aims for future tax-free qualified growth. Sending the $800 of earnings to a traditional IRA keeps them tax-deferred and avoids current taxation. This approach uses direct transfers and avoids the pitfalls of commingling and indirect rollovers. Next, let's solidify this with a short case study. Consider Maya, who changes jobs and receives a defined benefit refund consisting of $7,500 of after-tax contributions and $600 of interest. She instructs direct trustee-to-trustee transfers. The $7,500 goes to her Roth IRA, and the $600 of interest goes to her traditional IRA. There is no current tax. The records remain clean, and she positions the after-tax principal for potential tax-free growth. With the case clear, let's cover common pitfalls to avoid. Avoid taking possession of funds, even for a short time, because it can trigger withholding and the 60-day clock. Do not commingle after-tax principal with pre-tax money inside a traditional 401k because it complicates accounting and risks tax errors. Review your 1099-R and 5,498 confirmations to ensure they match your intent. Finally, do not ignore plan-specific rules for non-qualified or defined benefit refunds. Now, a quick knowledge check. Question: true or false? It is safer to receive the rollover check personally as long as you redeposit within 60 days. Options are A. True and B. False. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. False. The safest route is a direct trustee-to-trustee transfer. Receiving the funds personally can trigger withholding and starts the 60-day deadline, significantly increasing your risk of taxes and penalties. With that clarified, let's add a quick markdown cheat sheet you can screenshot. Here is a quick markdown style checklist. Identify whether your money is pre-tax 401k, Roth 401k, after-tax non-Roth, a defined benefit refund, or a non-qualified plan. For after-tax funds, split principal to a Roth IRA and earnings to a traditional IRA, or intentionally to a Roth IRA if you choose to pay tax now. On paperwork, request a trustee-to-trustee transfer and obtain a letter of acceptance. On forms, check your 1099-R codes and Form 5498 to confirm proper reporting. Avoid indirect rollovers, commingling, and missing the 60-day deadline. To close out, let's reinforce the core process with one more diagram. This mind map will consolidate the entire process. Starting from a job change rollover, you first identify the money type. You commit to direct transfers only. You split after-tax funds into principal directed to a Roth IRA and earnings directed to a traditional IRA or to a Roth IRA if you accept current taxation. Pre-tax funds go to a traditional IRA or your new 401k. Documentation includes 1099-R, 5498, and custodian letters of acceptance. Finally, you avoid the 60-day timeline risk by never taking possession of funds. Now, let's summarize key takeaways. These are the key takeaways. Know your money type before moving funds. Use trustee-to-trustee transfers exclusively. Split after-tax principal and earnings rather than commingling them. Send after-tax principal to a Roth IRA and route earnings to a traditional IRA if you want to defer tax. Verify everything with 1099-R and 5498 forms and keep a complete paper trail. With the essentials recapped, here is the final summary. To wrap up, start by identifying the exact money type, because it determines where the funds should go. Use direct transfers to avoid the 60-day trap and withholding. Route after-tax principal to a Roth IRA and send the earnings to a traditional IRA, unless you deliberately convert and accept taxation. Keep meticulous documentation and confirm your forms. Finally, let's end with a thank you and a quick request. Thank you for watching. If this helped you avoid a costly mistake, please like, share, and subscribe. Tell us in the comments what part of the rollover process is most confusing for you and what topics you want next. See you in the next video.